For those of you thinking it's going to get better in the single-family housing market, I don't have great news for you. Stick around, I'm going to tell you why it really sucks right now. But if you're an investor, it may just be a silver lining. Stay tuned. Hey everybody, I'm Greg Barron, professor of real estate. I'm going to give you 4 reasons why it just still sucks to be in the single-family market. But I'm going to give you 1 reason why, as an investor, it's going to have a good outlook potentially in the rest of 25 through 27. Here's a reason why. You know, what's happening with the tariffs right now is not really a friend of the housing market. We already have a housing shortage, millions in housing shortages right now. And what's happened basically with the new pronounced tariffs that are happening, it's creating this level of instability, especially in the commercial real estate market. CRE Daily just came out with an article stating that it's really giving a lot of headwinds to making decisions. And the last thing that the stock market and the commercial real estate market needs is instability. Basically, nobody knows what's going to happen. What we do know is that 25% tariffs will potentially create additional building and commodity pricing costs for us that are in the industry. What we'd rather deal with is going back to normalcy, but the administration feels that some of these tariffs are going to create some long-term redistribution of wealth in America, a correction of the import-export imbalance. I'm not an economist. All I know is I am boots on the ground right now. Our companies weekly and if not daily are looking at costs associated with putting things into place, value adds, doing ground up. And I can tell you that we're all a little bit unsettled right now because we really don't know where our ultimate cost is going to be, especially those things like lumber and aluminum. And it's also potentially affecting steel prices. Those of us that are in the commercial industry are still wondering just what's going to happen. So what happens with instability is people delay in making decisions. So it really is in somewhat of a turmoil right now, but I'm going to give you 4 reasons why, regardless of that, the single family market and the building of those single family homes is really in a state of flux as well. And the main reason that we've got a disruption here is because of affordability. You're going to continue to hear this, and there's no real great solution except for a few things that I'm going to speak to at the very end of this video. But let me first tell you the 4 reasons why it just sucks right now to be in the single family market. Number 1, as an employee, and we've got a lot of them, but if you look at the Fred graph over the course of 10 to 20 years, you'll realize that wage growth has not kept up with inflation. When you don't have wage growth, you can't pay higher rents that are being commanded right now, so more of your disposable income is being eaten away simply because you have to spend more on shade and shelter. So unless wage growth continues to rise with inflation, you're going to continue to see headwinds getting into that first home or elevating into another home of higher value. Number 2 is, as a tenant, going into properties, what you're going to see is an escalation or rising of rental rates if you're not in home ownership. Now, why is that? Well, it's the lead lag effect that we've experienced for the past few years. To have a balance in a rental market that's in favor of the tenant, you've got to have an oversupply product. Well, what's happened since 2022 around February is you've seen really no real new starts. So all the product that is out there is really the most that's going to be out there for a while, probably a couple more years. Until rates come down, you're not going to see any new construction starts. So as you think about it, as a tenant, what you really want is an oversupply product so that your rates will go down, so that concessions will increase, and it's more favorable to a tenant. But we're not having that right now. And you probably won't see any construction starts until rates are more normalized. Right now, new projects are just facing a tremendous amount of headwind themselves, mainly because of interest rates. So what I predicted before and what I think is happening is You've had a lowering of rates because of the supply that came on that started in 2019. But now, as those start to stabilize, you're going to have more demand for it. Concessions are going to decrease, and rent rates are going to elevate from 25 on through 27 and maybe beyond. In addition to that, from a tenant's perspective, you're seeing less and less single family sales. Every month over month, year over year, you're seeing a reduction in the amount of product of single family homes that are coming online. The main reason why is because if it doesn't pencil out to create more product for new developers, the same thing applies to single family home buyers. 80% of most rates are below 4% right now. You've got the lock-in effect still, and as mortgage rates are still above 6%, you're not seeing those people move into single family homes. You're not seeing first-time home buyers make the move because of the affordability issue. In addition to that, as a tenant, we continue to see rising construction costs and very little abatement of long-term 30-year loans. It only means that you're going to see a movement more into the multifamily market. And again, as that happens, you're going to see a rise in rental rates. So it's not faring well for the tenant out there either. So affordability, both in the rental market and in the single family home market, are going to take a while to correct. So let's talk about builders and developers. We are firmly in that space. We have an engineering company that all we do is develop land lots for ourselves and for other developers. And we're the canary in the mine. I can tell you that the production of those lots has gone way down, almost half of where it was 24 months ago. What's the reason? Builders are facing some headwinds as well. Number one, you still got interest rates that are above 6%. Your land costs have not abated. As a matter of fact, they're going up. You're also seeing building costs continue to increase. We just estimated a large multifamily complex in the DFW area, and even on that project, we were $1.5 million over budget, and now we're going back to doing what's called value engineering to try to whittle away to try to get our numbers to work on this particular project. The problem with that is we have uncertainty about the tariffs. Why? Because we haven't bought our lumber package yet, and we're afraid that we're going to see an incremental rise of another 15% in one of our major cost components. We've also got other commodity pricing that's going to affect those things that go into it. So there's a tremendous amount of uncertainty right now as a builder or a developer. In addition to that, being in the space, we're also seeing our operating costs rise once they're stabilized. We have had at least a 25% increase in insurance costs. And with all the wildfires that's going on right now and all the things that have been happening, we don't see that abating. It's going to be a major component in all of our projects moving forward. So as a builder or developer, it kind of sucks right now too. We have uncertainty. We've got rising operational costs. We've got rising material costs. Interest rates haven't abated, and we don't expect them to materially until 2026. So there's very little new product that really we're even interested in right now that will pencil out. So the last thing I'll say about the difficulty right now in affordability is being a landlord. Even if you got operational product right now, what we're experiencing is a struggle to keep that net operating income up so that our debt service coverage ratio, or the amount of money that we have to service the debt on the product, remains within bank covenants. We're not alone in this. I know a lot of people are in worse shape because of this. Their DSCR and debt yield scores are just in the tank, and the cap rates have continued to rise and haven't retreated. So it's a double whammy. So being a landlord right now, and you're coming to the end of your 5-year adjustable rate, you've seen operational costs rise, you've seen building costs rise, you've seen labor costs rise. So making those numbers pencil out as an existing landlord equally is a struggle right now. So what's the silver lining in all this? Well, I've just talked to you about the 5 reasons that it kind of sucks right now. with the affordability crisis and with the ongoing tariff uncertainty and the interest rate structure the way they are, if you're an investor moving into 25, you're still licking your lips. The forecast for 25 to 27 is actually quite good, but it's good if you're buying existing properties that are on the market that have experienced those things that have destroyed the value. So let's talk about the reasons that I think 25 and beyond are going to be good. If you look at the recent reports that have come out, you're seeing this massive amount of commercial loans that are still coming due, and banks are going to be struggling even more and more. I keep up with Florida Atlantic's chart system on banks that are over-levered, and there's plenty of those where their total exposure to commercial real estate exceeds their capital, in some cases by 400 to 500%. Those banks are going to have trouble, and those CRE loans that they're holding on their books in the rest of 25, there's going to come a time where that can just can't be kicked down the road anymore. The whole extend and pretend or pray and delay is coming to an end in 25. I see this because the numbers continue to increase for those that are going into servicing, for those that are really coming to the end of their line where you're either going to have to evergreen the loan some more or modify it. They've modified it for the last 2 years, and the regulators are not going to let them modify it any longer. So there's going to be new product that comes on where cap rates are going to be high, which means the valuations are going to be lower. You know what your operational costs are going in. You're going to have to do your pro forma evaluation, assuming that those costs are going to continue to rise. But the great thing is, people aren't going into single family homes like they were. So where are they going to go? They're going to go into multifamily. And because there's a lack of product that's come on to satisfy this migratory need for more multifamily housing, rates will start to rise even more. Now, that's not good news for the tenant because the tenant's already facing somewhat of a crisis. So I'm not really sure how that particular dynamic's going to play out. All I know is when you don't have any more product and you reach a higher and higher vacancy, your rents are going to rise. Additionally, I think those that get into the market between now and 27 are going to see rates start to decline. They're going to enter the market with a depressed value, and they're going to ride the wave of the rent incremental increase back up again, which ultimately is going to push cap rates down, which is going to increase value. So the next 24 months for investors are actually quite good. So even though it really sucks in the affordability issue for single family home buyers and those that are wanting to elevate into the next level, it's going to be a really great time for investors to get into the market, to capture some really good multifamily housing values and ride that rent wave back up again. So bad news, good news. It's like my attorney says, which side do you want me to negotiate from? I can make a compelling case either way. I want to be on the side of the investor for the next 2 years. As always, thanks for watching today. If you're enjoying it, leave me a comment. I'll try to get back to you as quickly as I can. Like and subscribe if you want me to keep doing these videos. And as always, educate, evaluate so you can ultimately execute to increase your own personal wealth. We'll see you soon.